Yeah, so gold historically follows forward expectations of real yields, and that's because the treasury market is a very financialized market, the gold market is a very financialized market, and so generally it's gold's kind of a long duration asset, and so it looks at those longer duration forward outcomes, which is it's challenging because those yields can be impacted by the Fed. The market's expecting disinflation for a period because some of the economic heat is coming off. Generally, you have copper go down, you have gold go up. Because the Fed's buying so much of the treasury market, I can't use that as a reliable signal of what inflation is going to be, but it's still a useful directional signal. You'd have to have something change the market's perception of forward inflation because it still seems that the market is buying into the transit inflation, and to some extent that's correct because I think this 5.4% figure we're getting is not going to stay at this level, say maybe by the end of this year, but I think it's still probably undershooting what the average inflation is going to be over the next 10 years because the Fed is active in kind of manipulating that market to some extent. Yeah, inflation has been a big topic that I've been covering really for the past couple years, but of course, especially starting in 2020 when we saw this very large fiscal burst. And of course, it wasn't immediately inflationary, but my projection was that as we look out a period of time, that would start to become inflationary when economies reopened and when that money started to run into certain constraints. And so we kind of see here in 2021 that some of those inflationary pressures have manifested. It could go either way, and it's often a mix of both. And so if you line up, say, the gold to copper ratio with a 10-year treasury yield, you generally have, it's pretty correlated because you'll get these periods where the 10-year treasury yield goes down because the market's expecting a little bit of disinflation for a period because some of the economic heat is coming off. And so you have copper go down, you have gold go up. But that, of course, you could have copper go down a lot and gold just stay flat. You could have gold go up a lot and copper kind of stay flat. And so that could take a few different forms. So overall, my base case would, because as you point out, the copper market is, a lot of people realize that there are a lot of, upcoming, issues between supply and demand. And so I think it's unlikely that we'd have, a massive copper decline. And so my overall base case is that copper could just kind of consolidate for a period of time, correct. We've already seen it correct to some extent. While I think gold could, stay flat, move up to some extent. I think it's, it's more in gold's favor at this time. But I think you can see that little bit of a both sides of that ratio. During last year, you actually had the biggest ever, they front ran that so much. So they issued a ton of bonds and they bought that cash account up to like 1.8 trillion. It was by far the biggest it has ever been. Usually it's a few hundred billion. And so when we switched from Mnuchin to Yellen, that they basically started drawing down that Treasury General account. And so previously you had a period of issuing more bonds than you were spending, and now you're spending more bonds than you're issuing. And so that actually curtailed the new supply of treasuries when you have the Fed buying 80 billion a month, and when the Treasury General account is drawing down, so you're not issuing bonds at as fast of a rate as you're spending money. And so I think those, that combination of, a lot of institutions have collateral requirements. Those supplies were somewhat limited, and the Fed is still buying a large amount of them. And so that's overall kind of kept yields low. And then, yes, and I think the past month or so, I think yields have kind of fallen further in response to concerns about Delta variant, and then more directly, lockdowns associated with Delta variant and how that can impact economic demand, how that can impact, say, retail sales, restaurants, oil demand, some of those inflationary levers, and some of those economic growth levers. But it's interesting because, what I generally find is that because the Fed's buying so much in the treasury market, I can't use that as a reliable signal of what inflation is going to be, but it's still a useful directional signal, if that makes sense. I think it's off by magnitude, but it still gives us some signal in terms of direction. Yeah, so gold historically follows forward expectations of real yields, and that's because the treasury market is a very financialized market, the gold market is a very financialized market, and so generally it's, gold's kind of a long duration asset, and so it looks at those longer duration forward outcomes, which is it's challenging because those yields can be impacted by the Fed. And so, for example, if you look at what gold is highly correlated with, it's those long duration real yields. So it's the treasury market minus the break evens, the inflation break evens, that the tips market gives us. Now, of course, the complicating factor is that the Fed is active on both sides of that. They're buying normal treasuries and they're buying tips. And so those forward break-evens are a noisy signal. What we have seen from them is that even though we're having this big inflation spike right now, those are still somewhat tame. And so if you look at, say, the real yields of the 10-year treasury, it's back down to about -1%. And that's where it was this past August when gold had its peak. And so, we haven't really broken through it. I think the absolute bottom was at -1.08% for the 10-year minus the 10-year break even. And we haven't really broken through that. And so that's been consolidating in a similar way that gold's been consolidating. I think there's a couple factors here. And so, one thing is worth pointing out is that actual inflation levels and 10-year yields have gone in opposite directions. So inflation is we keep getting the surprise upsides, above economists' expectations. At the same time, its 10-year yield has been cooling off. So you actually have one of the biggest gaps in terms of real yields. One of the most deepest negative real yield environment. And I think there's a couple factors there. One is obviously the Fed is still buying a large amount of treasuries, and that's true for most central banks around the world, where they're buying a large portion of their own sovereign debt, and so they're taking excess supply off the market. Because otherwise, it would overwhelm demand and you have yield increases. So when you take a lot of that supply off the market, it gives the market a smaller segment to then go and price. We also saw over the past several months the Treasury General Account go down. And so for people that aren't aware, the Treasury holds a lot of, when they issue bonds, they bring in a lot of cash. And when they spend cash, they do their government activities, they spend that cash. And in the meantime, they hold that cash with the Fed in the Treasury General Account, the government's gigantic checking account with the Fed. There's surveys of consumer expectations of inflation. They tend to run a little hotter. It's also interesting, too, if they break that down by age, they find that generally older investors are expecting more inflation.
Right.
Many times because they've lived through it, whereas younger investors haven't. But generally consumer expectations of inflation run higher than the official forward break-evens. But if you look at the market over the long term, generally these past, say, 5 years, you've had very tight correlation between gold and those break evens. And the longer duration you pick, the better, right? So it's somewhat correlated to, say, 5-year break evens, but really you have to look at the 10-year break evens or longer, and those generally tend to be pretty inversely correlated with the gold price. That would start to become inflationary when economies reopen. I think it's unlikely that we'd have a massive copper decline. So when we switched from Mnuchin to Yellen, that they basically started drawing down that Treasury General Account. Gold historically follows forward expectations of real yields.